To do this right, you really want to look at a few things. One is, when is the likely time that you're going to want to retire, for example? I mean, obviously, there's contingency things that you want to put in place in case of death or disability, but in a planned transfer and retirement, when do you want to do that? And what do you need to get in place? Do you have the right people already internally to be able to successfully do an internal succession deal? Not only to get the deal done, but who can successfully run the company so that you get your money, your back-end money. Not to mention the fact that you probably want the company you've created, the clients to be well handled and your legacy to be preserved and things like that. Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On the show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My name is Corey Kupfer, and I've been supporting deal-driven growth for businesses for 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest podcast. Let's get started. Hello, DealQuest listeners. This is another solocast where we're going to do a deep dive into a certain type of deal. And this deep dive is going to be on a deal that we refer to as an internal succession deal. And I'm going to talk a little bit about what I call internal succession planning, and then we're going to talk about, the deal structures and some of the aspects of a deal for this. I mentioned this when 2 solocasts ago, I think it was episode 80 of the podcast, where I talked about team in episode 80. And I mentioned the fact that one of the advantages of building a great team and empowering them and creating the right people and, having flexibility and respecting them and drawing from a bigger pool, whatever, is that not only do you create a freedom for yourself to do other kind of deals, and you also create a company that's less dependent upon you, which can be great for building enterprise value, to getting a better exit deal, which a lot of people think of in terms of a deal sale to another company. But it also creates a better option for an internal succession deal and creates a pool of potential buyers for the key people that you've built on this team, who have grown this great team and empowered them and had, great people. Well, they're a potential option for you to buy. So what is an internal succession deal? So an internal succession deal is just really an opportunity to sell your company to your existing team, to your people, to your key executives. And I'm not talking about an ESOP here. Let me make a distinction. Right? People have termed ESOP, employee stock ownership plan, which frankly, for most entrepreneurial and growing companies is not a good option. Bigger companies, it is. They're often ERISA qualified, complex plans, that kind of stuff. This is not what I'm talking about here. I'm just talking about when you have a company where you might have 1 or 2 or 3 or 4 or 5, a handful of employees, key executives, people who have been with you for a while who are helping to run the company. And frankly, if you've really gotten into a place where you're working on your business, not in it, they're running it day to day successfully without you, they become potential buyers for the company, especially if they have a longer runway than you are, right? Likely younger than you, but age isn't really the factor. The biggest factor is that they have a longer time period that they're planning on working than you are. So they become an option for you to buy the company. Let's talk about the advantages and disadvantages of a internal succession deal versus an external succession deal to start with. One of the advantages is that they know the company, right? The need to do due diligence, depending upon, of course, how much transparency they've had into certain things like financials and things like that. I mean, I'm not saying there's no due diligence on the part of internal buyers, but they know the culture of the company, they know the clients, they know the people, they know at some level how well the company is doing, whether you, depending on, again, the transparency into financials, they may know a lot, they may know a little, but in general, they're there, they're comfortable, they're getting paid, they know the company's doing well, they know that it's growing, they know there are clients, they know who their teammates are, they know most things about the company. And so the due diligence level, the finding, not only in terms of time, but in terms of things they might be worried about, is probably a lot less. Now, they also know your skeletons, by the way, more than an outside buyer would, so that could theoretically be a negative. But you know what? If you built the right kind of company with the right kind of team and you do great work for people, those skeletons aren't going to be anything significant, and it's not going to stop a deal. And hopefully you don't have any or many or anything significant. So that's a big advantage, right? Know the company, less due diligence, they're comfortable. You don't have to sell them on that. The other advantage is continuity. Certainly, if you're in any kind of service business and listen, even in product businesses, right? Relationships matter in business, period. Unless you're, a tech company where nobody ever speaks to a human, maybe it's a little less here. But in most businesses, the continuity of the team, the continuity of people, especially when customers hear that there's a sale and that the founder might be leaving, and by the way, you can do these deals abruptly, but you could also very often do them over time where there's it's not as abrupt to the market and to the clients. But the point is, if the team is staying on, there's much less chance of there being disruption in the client relationships and the customer relationships. There'll be much less chance that somebody's going to relook at their relationship with your company and say, oh, Corey's leaving. Maybe we should rebid this contract. Maybe we should put it in an RFP. Maybe we should just consider competitors or alternatives, or just relook at things because they're selling to somebody new. If the team is staying around, especially if they're the ones who have been servicing the clients and maybe are close to the clients that you are at that point, if you've built a company that's less dependent upon you, then it is a great easy transition. The other thing is, although this is not always the case, almost every deal, when I said almost every, the far majority of deals are done as asset sales, not equity sales, not stock or membership interest in LLC, because of the buyer doesn't want to take on a liability risk. And that's certainly true with external sales, and almost always it's going to be an asset sale to an external buyer, unless you happen to be a C corporation that has, for example, NOLs, net operating loss carryforwards, that are valuable, or there's some other issue. Well, very often that is also the structure for a internal succession, but there's more often the case where you might be able to do it as an equity sale, because again, if employees have been there for 10 or 15 or 20 years or long enough where they're comfortable that there aren't skeletons in the closet and the liability risk is low, they might be more willing to be a buyer of an equity sale, and that could be advantageous to the sale. Now, there is different tax treatment. You got to look at that, especially if it's a family situation where you can't take a step up in basis through a certain tax election. I won't delve into the tax details in that, but asterisk tax thoughts, right? And again, right, I'm not your lawyer. I am a lawyer. This isn't legal advice. Get your own legal advice. Happy to help you if you need us. We'll go to your own lawyer. The point is that, absent the structuring and tax issues, which you can often work through, especially in a non-family situation, it's often smoother to do an equity sale, because when you do an asset sale, every contract needs to be assigned to the new entity. And most contracts don't, have restrictions on assignment, or at least consent requirements to get it assigned. And when there's a new buyer that's buying the assets, whether it's leases, equipment leases, client agreements, you name it, any contract you have of any type, you probably have to deal with assignment issues. Now, because you do it as an equity sale, stock sale, membership interest sale, whatever it is, on the equity side, it doesn't mean that you will not have some consent requirements or change of control requirements, because some assignment clauses, an assignment means that it's being assigned from one company to another. But some of provisions also cover a change of control, which would effectively raise the same issues as an assignment. So if the contract says if there's a change of majority control of the company, you need our consent to have the contract continue, right? Or that it's restricted outright, then you might still have the same issues. But it's surprising, actually, how many agreements have no assignment provisions but do not have change of control restrictions. So it may cut down on the number of contracts you have to deal with. Also, if you do an equity sale, you can keep things like payroll and benefits, because it's the same company. It's the same company that's staying in place, just different ownership. All of those things stay in place from before. Whereas on an asset sale, you often have to deal with all of those, the payroll company and the benefits company and the health insurance and all that stuff. Now, by the way, all of that's doable, totally doable. The far majority of deals are asset sales, it all gets done. But there are some reasons why you might want to do a stock or equity sale. And although it's still the far minority of deals, even in an internal succession, it's a little more likely that that is at least on the table than in an external succession situation where they're definitely not going to want to take on the liabilities absent some, unusual reason to do that. Those are some of the advantages. Also, another advantage for an internal succession, and this goes into the planning concept, is the ability to incentivize, attract, retain key talent. Because if they know that they're going to be buyers of the company, then it's, that's a perk, that's an incentive for them to stay. And, you may not, for key people, be able to pay them, maybe they're getting better pay offers from bigger companies. But if they know that they're going to be able to have an ownership when you retire, or by the way, very often, because, these deals can be done a few ways. You can set it up where you have an agreement now where they take over ownership, where there's a buy-sell essentially, where they're going to buy it when you're gone. But you can also build that into sort of a partnership track or an ownership track where they get equity over time, small percentage to start, building over time, and they even buy, they buy you out over time, where eventually they get majority or total control of the company or 100% ownership of the equity, but it's done over a period of time. But either way, that becomes an incentive for key talent to stay, even maybe if they are being offered better compensation or benefits from a bigger company. So that's another advantage to put that in place in advance. And this is where the planning comes in, right? Because if you wait until you're, 6 months away from retirement, then first of all, you haven't gotten any of the attraction, retention, incentive benefits with your employees, unless you've just made a promise to them it's going to happen, they trust you. But, it's much better to have, for those incentive benefits, to have them have a legal agreement in which they're guaranteed for that to happen. But also, you limit your options, because the chances of getting any deal done, external or internal, if you wait too late, are small. And on the internal side especially, unless you want to own or finance it, and this brings up, a next interesting topic, if you want them to be able to borrow money to be able to fund the buyout, their ability to do that is much more likely if you're buying out over time than if it's all at once. Plus, they need time to get that financing in place, right? So you want to plan in advance to be able to have them be able to do that, and having them buy it over time with, maybe a smaller loan to start with. And then, as they get more equity, they borrow more money. That makes sense. Now, that is one of the downsides, by the way, and it depends upon industry, of an internal succession. In some industries, there's not a lot of money available, for people who may not have their own balance sheet, right? Significant assets of their own to back up lending. And then in some industries, this used to be true in the investment advisor space up until, maybe about 7-8 years ago, where there were very limited funding options in the space. And what would happen is a lot of times the internal buyers, the employees, would want the owner to basically take a note, right? To self-fund, finance the buyout. And a lot of times the seller, the founder would think to themselves, well, why am I going to do that? I mean, basically, if I'm going to get paid over time, I might as well just keep owning the thing and I'll keep taking my cash out and I just won't work as much. And so that was often a deterrent to an internal succession deal, to a sale, because of that. Now, for example, in the investment advisor space, there's become a lot of financing options that there never used to be. And in various other industries, there's certainly financing options because the buyer is now, the employee group, right, is not only relying upon their own credit, but they are able to have the value of the company, the equity, right, the cash flow of the company, the receivables, all that stuff, any hard assets, if they're in manufacturing or other business where they have hard assets, become collateral for the loan as well. So if you plan further in advance, there's more chances in certain industries of having funding available, outside funding for the executives and employees who want to be the buyers, so that you as a founder, as a seller, if you're on that side, could get either all or at least a larger percentage of your money at a closing up front because they're able to finance that deal. So that's an advantage. Let's take a break from the show for a minute so I can invite you to join our DealQuest community group on Facebook. There, you'll have a chance to engage with other entrepreneurs, business owners, executives, and leaders who are looking to grow, do deals, and make a bigger impact. In addition to the great content and community, you can also register there for our Conversations community and cocktail Zoom calls and the upcoming Deal Den Zoom calls, during which you will have the opportunity to brainstorm and get support with deal-driven growth for your company. Now back to the show. Let's talk about a couple of negatives. often, although now that financing, in industries where financing is in place, it's cut the gap. But because you are limiting your sale to an internal succession, unless you're going to compare it to external options, you can potentially do that. But often there's some discount, some haircut on the price because the deal is easy to get done. It goes to people you trust. Well, like, are you going to get paid? All that kind of stuff. A lot of times the valuation that you give internal buyers is going to be lower. It could be a little lower. It could be, somewhat lower. I mean, it's not going to be 50% or something, but it could be 90, it could be 80%, it could be, there's usually some haircut on the valuation for internal buyers. Not always, but often. And because external buyers, might have just much more resources, much more cash, much more funding, but they also might have other strategic reasons why it makes sense for them to buy your company, which makes your company more valuable to them than it is a standalone that will have them offer a lot more money. The classic case of that is, at sometimes an extreme, is when a roll-up company or an acquisition company comes into your space and they're paying much higher multiples than your individual company is worth because they're going to roll up all these companies and go public or sell them at even a much higher multiple. But even when that doesn't happen, when you have external buyers, they'll often be strategic in other reasons, including access to capital reasons, that they might pay a little more. You could be taking a discount in an internal sale. Now, let's talk a little bit about how these things are often structured. So again, you could set it up where people are buying in over time, 5% a year, whatever the numbers are. Obviously, it depends upon how many people are in the buying group. If there are going to be multiple people buying, you're going to be bringing them in or anybody buying, and you're still an owner. In other words, they're not just buying 100% from you upon your retirement or death. You're going to need to bring them into a shareholders agreement or operating agreement, which we talked about on the last solocast on, I think it was episode 84, where we talked about like business partnership and some of the terms around those kind of agreements. So you'll need to deal with that. If it's 100% buyout, you don't need to deal with that, but you'll need to deal with things like, okay, how much were you getting up front? How much is paid over time? And that's the other thing that happens sometimes for any portion that's owner financed is sometimes it'll be payable over a longer period of time than the back end money that you get on an external deal, again, for cash flow purposes. The other thing that often comes up is when you're allowing employees to buy in over time, very frequently the founder does not want to be in a position where they still have ownership, but it becomes a minority ownership interest, at least not in terms of voting control. Sometimes you'll structure it where they can keep buying and you end up with under 50% of the equity over time, but you still control decisions. This is not universal, but most owners don't like the idea of, like many of them at least, when they get to the point where they're going to lose control of the decision-making in the company, they often want to be out totally. So sometimes you'll see, or, relatively often, not all the time, you'll see structures where people are buying in, and now they have 5%, 10%, 20%, 30%, up to 49%. And then the next block is basically they go from 49% to 100%, right? They're going to buy the other 51% at the point where the founder owners are ready to, retire or pass away or whatever, where they want out or, out because of circumstances. That's something to think about on if you are a founder owner, whether you're willing to be in a structure where you do have a minority ownership interest. And again, you could divide voting and economics. So even if you own 5%, you could theoretically still control the voting by contract. But, do you want to be in that position where you lose voting control at some point but still have ownership? Or do you want to structure it where you have voting control until your last ownership is paid? Or do you want to, or bought? Or do you want to structure it where, the minute it goes above 50%, you're going to sell out everything? So those are some things to think about in terms of the structure on buyouts over time with employees. The other things are, what kind of security or guarantees are you going to get for any back-end payments? What is, very, very common if you're doing an asset sale is to have the assets you've sold, meaning the equipment, the hard assets, but also client lists, goodwill, that kind of stuff, name, be security for the back-end payments. So if the buyers, the employees don't pay you, you can foreclose, basically. You can take back the company. Now, in legal theory, that sounds nice. But in practicality, first of all, obviously, if you've died or become disabled, you're not in a position to take the company back, and your family probably isn't either, except maybe to take it back to sell it to somebody who could run it, and that's a disaster, a mess, and you're not going to get a lot of value there. But even if you're just retired, most people don't want to be in a position where they got to come out of retirement and back into their company. So although that's a standard part of the security for back-end payments, it is not something that's, that really gives a lot of peace of mind or comfort because of the desire not to have to exercise it, even if things go wrong. So one fundamental question comes up is, are you going to get any other kind of security? Are you going to get any other kind of protection? Are people going to, give you a second mortgage on their home, or have any other personal assets that they can pledge? In many cases, they don't or don't want to. And then, it comes into this interesting psychological thing of, hey, sometimes frustration with founders, entrepreneurs, because employees want the best of both worlds, right? They don't want to take on that entrepreneurial risk, but they want the upside. So those negotiations happen a lot of times. But sometimes they're just not in a position to do it, or their spouse is like, no, you're not mortgaging the house. And you got to make a decision on whether you're comfortable with that. The good thing about an internal sale, although again, there's no guarantee what happens in the future, and especially when you're out of there. But, if you're selling to a management group or key executives who you've known for a long time, you can make that judgment on whether they're going to, one, be able to run the company successfully, because sometimes they can't pay because things aren't going well, in which case, practically, what are you going to do? You're going to put the company out of business? You're probably going to figure out a way to work with them if the economy's gone down, or even if they've, messed it up a little bit, because you can insist on, they may not, if they don't have the money to pay you, what are you going to do about it? But you'll also be able to make the judgment of that they're not the kind of people, hopefully, who are going to, defraud you or screw you or be able to pay you and just not pay you. And you do have that, and that's why the lien on the assets of the company, even though you don't want to exercise it, does give you some leverage if somebody is being stupid or or immoral or breaching the contract. So but that is a concern. Whereas if you have an outside buyer, especially a bigger company that's well funded, the collectability or the ability to get your money on the back end is probably higher. At the same time, by the way, if they turn out to be bad actors, they're a bigger gorilla to go fight against. So that's a negative to an outside deal versus an inside deal. You have more leverage probably on individual executives than you do on a big buyer who may throw their weight around and claim, for example, that there were breaches of representations and warranties, and therefore, they don't have to pay a back-end purchase price. So it cuts both ways. So how much money you get up front, how much money you get on the back end, how much it's going to be secured. You want to actually deal with, well, what happens if they sell the company at some point? Usually you're going to want an acceleration of your purchase price, right? So even if it was paid over 5 years, if they sell it in year 2, you're going to want the right to get paid in full as a condition of that sale. So, there's some provisions like that. And then, there'll be a question as to whether you're going to be out totally at the point that they buy you out, or, maybe you have some ongoing employment role or referral arrangement or consulting arrangement. So that, that's all. And then you get into the whole question about valuation in terms of, what they have to pay. And we talked a little bit about, outside valuation in past, versus some sort of formula and, in past solocast. So I won't get into detail there. But the last thing I really want to talk about is less the deal structuring, but the planning part of it. To do this right, you really want to look at a few things. One is, when is the likely time that you're going to want to retire, for example? Obviously, there's contingency things that you want to put in place in case of death or disability. But in a planned transfer and retirement, when do you want to do that? And what do you need to get in place? Do you have the right people already internally to be able to successfully do an internal succession deal? Not only to get the deal done, but who can successfully run the company so that you get your money, your back-end money. Not to mention the fact that you probably want the company you've created, the clients to be well handled and your legacy to be preserved and, and things like that. So, what is your plan? Do you want to just work like, the full time and then retire totally and be out? Do you want to wind down over time and you want to structure to allow for that? Do you want to allow this partnership or ownership track where you're going to bring people in slowly to, sort of incentivize them and keep them there and have them be more vested in the success of the company even while you still own it? If you have multiple owners, I remember, we had a 5-owner founder company where we did a whole survey. So one of the things we do in addition to the legal work on it is we do succession planning for companies on a consulting basis. And we did individual interviews with each of the 5 partners because they all had founders, because they all had different timelines and different views and different objectives. And then, we took that and put it into a matrix and try to figure out if somebody is planning on working, dying with their boots on, quote unquote, and someone else wants to retire in 2 years and someone else wants to retire in 5 years, and and different people have different views on who should take over, or what their equity is worth, or there's a million factors. So obviously it gets exponential when you have multiple owners. There's a whole planning and consulting process that's necessary to figure out everybody's objectives, and not only of the founders, but also of the buyers of the next gen, right? Who are going to buy in, the executives, the employees. What are their objectives? Are they looking to be there for the long term? Or some of them looking to buy this and then sell it and make a lot of money? Those objectives have to get aligned. And then all the founders' objectives have to get aligned. The timelines have to come up. And then the relationship of when somebody is going to retire and leave in that founding group in relation to how quickly the next gen people want to gather equity has to be tied out. So there's a lot of planning, consulting, and thinking that goes into this that we do for clients on a consulting basis, especially when there are multiple owners. And you definitely want to think those things through, which is another reason why starting further in advance really makes a difference, because you have many, many, many more options when you do that. So listen, folks, internal succession, if you've built the right team first, obviously if you don't have the right people in place, you're in trouble for that, which is, again, if you're doing this in advance, you might say, wait a second, I need to bring in some key folks to have an internal succession solution. So let me do that. That's the first part of the planning process, is I need to hire 1 or 2 more people, have them be here for a few years, and then it'll round out the team of potential buyers who can successfully buy this company and run it when I'm gone. So that kind of, hiring and planning makes a difference. And, going back to episode 80, where I talked about building the key team for the purposes of just, success and growth in general, and then doing other kind of deals also obviously creates this opportunity to do a successful internal succession deal. And then we figure out, hey, we'll keep these people around, incentivize them. Do we give them equity over time? Do they have to buy in? Do we give them a discount on that valuation because of what they've done for us so far? Or maybe we've paid them well, so there shouldn't be any discount because they got paid for their services, but they'll buy in at fair market value, but maybe we'll self-finance it. There's all those kind of decisions that we do in the planning process. And then we, of course, document and structure those deals for clients. So I hope this is helpful for those of you who either have key people who could be an internal succession solution for you, or have a runway where you think you can build that. And it should at least be on the menu of things that you're considering. And listen, frankly, that's true even if you end up going with an external sale. Why not have more options, even if you're going to look at both? But at some point, and it may be well in advance of, when you can ultimately sell everything, you may start making decisions that move in a certain direction, like selling equity to small pieces to people over time. But doing that doesn't necessarily prevent an external sale. Depending on what your agreements say, you can even set up an internal succession agreement that says it'll go into place unless there's been an external sale before that. So you don't have to lock yourself into it, even if you started down that route. So those are some thoughts on internal succession deals, a little deep dive there. And like I said, in some of the past episodes, we'll be doing deep dives in some of these other types of deals as we go down the line. I hope you enjoyed that. Of course, reach out if you have any questions about deep dive on internal succession planning or succession deals. And we will come back to you next week with a new interview podcast, and then look out for our next solocast 4 weeks from today. Take care. Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. You can be a friend of the show by leaving a review on the Good Pods app, podchaser.com, or any major podcast player. Every review helps the show reach more listeners. If you're ready to take your deal-making to the next level by becoming a master negotiator, head over to Amazon or Audible and grab a copy of my best-selling book, Authentic Negotiating. Then connect with me on LinkedIn and let me know your thoughts. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.